Welcome back to FT Markets. The Federal Reserve has long reassured investors that rates will stay ultra low for a considerable period. But analysts are now wondering whether the US monetary guardians will opt for a more hawkish language at the end of their policy meeting this Wednesday. Should traders be prepared for an earlier tightening? And is the US recovery strong enough to withstand the shock? Discussing this with me today is Gavyn Davies, Chairman of Fulcrum Asset Management and an FT columnist. Good morning, Gavyn.
Hello.
So let's have a look at the first chart you brought with us with you today, and it's about the US labor market.
Yeah.
So there were some pretty disappointing numbers in August, but unemployment is still coming down.
Yeah, the last 6 months, the number of jobs created has been about 207,000 per month. So the unemployment rate has been tracking down, the red line here, consistently now for 4 years. But the debate, of course, is whether that is really genuinely showing a tightening in the labour market, because most of that is stemming from a drop in the number of people who want to work. The participation rate is coming down. And up to recently, Janet Yellen has been hinting that she thinks that participation rate may start to rise again. Unemployment will fall less rapidly, and that gives her a considerable time before she needs to think about a rate rise.
And of course, the other sign which everyone is looking at in order to understand the slack in the labour market is wages. And as we know from, as we can see from the next chart, real wages have not really been rising at all.
No. So because of the doubt about the labour market we've just discussed, people are now saying, well, let's wait until wages rise and use that as the ultimate indicator of whether the labour market is tightening. And what we see if we look at this is that the inflation-adjusted increase in wages remains around zero. So wages in nominal terms, what you get in your pay packet, are rising at only about 2%. And in general, the Fed has said that that is a signal of an easy labour market, which means they don't have to tighten now. Some people have said, let's wait until we see the whites of the eyes on wages and inflation before we contemplate a rate increase.
And in the next chart, we see how Treasuries are moving at the moment. And it seems like they're also quite stable. I mean, starting to creep up a little bit, but not
yeah,
certain.
But I think an interesting thing that is happening here is that the yield curve is flattening. So at the 5-year part of the curve, we're actually seeing rates now above anything that we've seen for quite a long period of time. And the market is beginning to think that even this week, we could get a hawkish signal from the Fed. The 10-year, though, until very recently, has kind of been tracking downwards. So the main signal we're getting from the bond market is curve flattening, which indicates that they're expecting the Fed to tighten, but they're not expecting, at the moment, a big impact on the 10-year part of the curve.
So overall, do we expect a change in the language this week?
I actually don't think we'll get a change. When Ms. Yellen said considerable period for the first time in her first press conference, she said that might mean 6 months from October, when the increase in the balance sheet ends. And at the moment, I think they're kind of thinking of the first rate increase sometime around the middle of next year. That's probably the central guess on the committee, which is more than 6 months away from now and more than 6 months away from October. So my guess for this week is that we get another FOMC meeting in which they leave considerable period in there.
Well, thank you very much for being with us today, Gavyn. So all eyes are on Janet Yellen and her colleagues. Let's see what they have to say this Wednesday.